Okay. Well, the build-up buy-in is really done. It works sort of similar to the Turnabout partnership, but the way you get your partnership interest is not because you've been managing it for years and you do this junior partner, senior partner. You don't do that, right? What you do is that let's say that you are a great salesperson. That you your ability is to take that product line of a particular business and dramatically increase its sales because of your contacts, your network, your sales ability, whatever the reason is, you have the ability to do it. Now, that's one contribution you can make to the company is you go to work for that company and you can generate a lot more sales for them. So your deal with the seller or with the owner of the company is right now your company is worth X, whatever X is. But if I come into your company and I build up your sales 20 or 30%, then your company is worth 20 to 30% more than it is today. So I'll come in and do this for you. You're going to pay me the same thing you pay any ordinary salesperson who works for you on commission or whatever it is. But as I build up this business to certain sales levels, which we'll call milestones, and as I achieve these milestones, I earned 2% of the business, 5% of the business, whatever it is. But if I make the business worth 30% more and you've given me a 10% interest in the company, you just benefited 20% of that value that you wouldn't have had you not worked this transaction with me. All right. So we do a build up buy-in. I'll come into the business. I'll hit these milestones. When I do, you give me a certain amount of equity, but whatever equity you give me, the remaining equity that you have is worth significantly more than if you hadn't made this arrangement. And you may work that, 2 or 3 times over a period of, let's say, 5 to 7 years. Not just 30. That is an arbitrary number until you own 20, 30% of the business as you hit these various milestones for making the company worth more. So at that point, you are the partner. You're the minority partner. So now you're going to do a turnabout partnership. Now you use the cash flow of the business in which you're a part owner to buy a bigger share of the business or to buy out the existing owner completely by retiring his stock. Okay. And by the way, there are certain tax advantages to doing it that way too. If I have to take my income and use it to buy out a senior partner in a business, I buy the shares. Okay. If I buy out the shares, I got to earn 100% earnings to have 75% left after taxes in order to buy that out. So I have to pay for it with after tax dollars that I had to go out and earn. All right. If I use the business income to retire the shares, I don't have to earn a dime. I don't have to pay taxes on any money that after which I have money left over to buy a business. It's just a smarter way to buy a business is to work out some way to give the owner something that enables you to become their partner. And from then on, look at the ownership of the business that you two have together to generate the income to reduce their share or the amounts of equity that they own. They get paid for it from the business, but every time their stock was being sold back to the business, your percentage ownership is going up, and eventually you buy them out completely. By the way, that technique was used by somebody who's was a famous person at one time, but today's generation may not know him as well. But the gentleman's name was Bing Crosby. And he literally bought out control of Minute Maid orange juice for a saw. He arranged for doing commercials for Minute Maid orange juice, which they had to pay him a lot of money for. So he says, don't pay me. And so, and back then the tax rates were between 70 and 90% for people in his income bracket. So he says, pay me. I'm not going to have much left over after you pay me and I pay the taxes. So they literally paid him in stock of Minute Maid, which made him a minority partner in Minute Maid. And then over time, he used the earnings of Minute Maid to buy out all the other owners. Okay. Their stock got retired. His percentage went up. He never had to pay any income tax on any of that money because all he did was get stock in Minute Maid in order as a payment, uh, giving him equity value. But then as he used the equity of an income of the company to buy out the original owners, there was none of that tax rate back then for the corporation. So it was all done with wonderful tax savings. It was all done where all he had to do was put effort into the company in order to create sales for the company. And as he created those sales, the company had lots of profits. The company used the profit to buy out the main owners of the company, leaving him as the majority owner of the company. And then eventually sold it out to a public company, made a ton of more. But the point is, these techniques have been around for years. The only people who've been able to use them are the folks who and the incredibly bright attorneys and accountants and top professionals that figured out how to arrange these things in the most advantageous way. Well, we have access to all those techniques today, and these are the ones that we apply to the benefit of just ordinary people who want to get into and control their own uh, little market company. Well, if anything that I've said to you makes sense, and if you'd love to have a team of top professionals who literally are going to get this done for you, you're going to want to click that button and get in touch with us so that we can get this done for you.